Welcome back to the show, everyone. Today, we're doing a deep dive into the YMAX ETF. It's specifically for you because we know you're looking to generate income with your investments. Now, YMAX might seem pretty simple at first. It's an ETF that invests in other YieldMax ETFs. But I think you'll be surprised to learn that there's some pretty interesting stuff going on under the surface. We're talking about things like compounding fees, a strategy that kind of limits how much you can gain, and really high turnover.
Yeah, there's definitely more to YMAX than meets the eye. That's why we're doing a deep dive on it. Sure, those high yields might look good on paper, but it's really important to understand how it all works. YMAX is not your typical buy and hold ETF.
Okay, so let's break it down. First of all, YMAX is about income, not growth. It's made to give you a steady flow of cash, but it's not going to shoot up in value like some other ETFs out there.
Exactly. And the way YMAX does this is through something called covered calls. It's kind of like this. The YieldMax ETFs that YMAX invests in, they basically rent out their stocks for a fee. They're giving someone else the option to buy those stocks at a set price, and they collect that fee as income.
So they're saying, hey, you can buy this stock from me at this price if it goes up, but you have to pay me just for the chance to do that. And that payment becomes income for whoever owns the ETF.
That's the idea. It's a pretty smart way to make consistent income, especially in a market where prices can be all over the place.
But I'm guessing there's a downside, right? There's got to be a trade-off with this covered call thing.
You got it. The trade-off is that if the stock price goes way up, your gains are limited. You've already agreed to sell it at a certain price, so you miss out on anything extra. You're trading potential growth for that steady income stream.
Gotcha. So that's a key point for everyone listening. YMAX is all about getting you the most income possible. But it's not meant to make huge price gains. It's a trade-off you have to be okay with.
And it's worth mentioning that even the guy who manages the fund, he doesn't advise people to use these payouts for their daily expenses. The goal is to reinvest those payouts and let them grow over time.
So it's more like building a snowball over time.
Yeah.
You're using that steady income to make the snowball bigger, not spending it right away.
Exactly. Now, things get a little trickier because YieldMax has recently added something else to their strategy. They're now using what are called credit call spreads.
Wait a minute. Credit calls, that sounds even more complicated than covered calls.
It is a little more involved, yeah. But the main idea is similar. Instead of just selling one call option, they're selling one and buying another at a different price. You can think of it like they're adjusting the covered call strategy, just to try and grab a little more profit if a stock does really well.
So they're giving the strategy a bit more wiggle room, but the goal is still the same.
Right.
Get that steady income coming in.
Exactly. They're still focused on income, but they're trying to get the most out of it, and maybe get a little more upside than a regular covered call would.
Okay. I think I'm starting to get it. YMAX uses covered calls and credit call spreads to build this foundation, and it's all to make a consistent stream of income that you can then reinvest. But how does that work with actual stocks? What kind of companies are we talking about here?
Well, you'll find a mix of names you probably recognize within YMAX. Big tech companies like Google and Tesla, chip makers like AMD and NVIDIA, and even some exposure to Bitcoin through a Bitcoin ETF.
Wow, Bitcoin. I wouldn't have expected to see that in an income-focused ETF. So it's not just about those slow and steady dividend-paying companies.
Nope, not at all. Remember, YMAX's whole thing is to maximize income. And they're using these covered call strategies on a whole bunch of stocks, even the ones known for big price swings.
Okay, so there's definitely some risk involved here. You're basically betting that these companies will either stay pretty stable in price or maybe go up a little so YMAX can collect those premiums without missing out on too much growth.
Yeah, you could say that. And don't forget that YMAX is a fund of funds. It doesn't actually own these stocks directly. It holds other YieldMax ETFs that focus on individual stocks.
So it's like a basket of baskets, and I guess that's for diversification, right?
You got it. By spreading the risk across multiple ETFs and stocks, YMAX tries to make the ride a little smoother. If one stock goes down while others are doing well, the losses are kind of balanced out.
That makes sense. But sometimes diversification isn't a good thing, is it? I've heard that the way YMAX rebalances its portfolio can actually work against investors.
You're right to be a little wary there. YMAX rebalances every month, meaning it adjusts how much of each ETF it holds. It does this to keep everything equally weighted. Now, this can be good in some situations, but it can also cause what's called a short volatility, short dispersion effect.
Okay, break that down for me. What does short volatility, short dispersion really mean for someone who owns YMAX?
Imagine that one of the stocks YMAX holds crashes, but the others are doing fine. YMAX, because it has to keep everything equal, will sell some of the winners to buy more of the stock that's tanking.
Ouch. So you're basically selling stocks that are going up and buying more of one that's going down. That doesn't sound like a good idea.
It can definitely hurt your returns, especially in markets where some stocks are making big moves. It also shows how YMAX isn't really made for huge growth. It's all about that steady income stream, even if it means missing out on some big wins.
Interesting. So even with diversification, there are things to be careful about. And we haven't even talked about how much all this complexity costs.
That's a really important point. Managing a fund of funds that uses option strategies isn't cheap. YMAX has an expense ratio of 1.28%, which is way higher than a lot of regular ETFs.
So it's not exactly a set it and forget it kind of investment, huh?
Definitely not. And besides the expense ratio, there are also transaction costs to think about. Because those underlying ETFs are constantly buying and selling options, those costs can add up and maybe even eat into your returns over time.
Okay, so we've got this complicated strategy, some downsides to diversification, and higher than average costs. It's a lot to think about. What does all this mean for someone who's looking at YMAX just for that income generation?
It definitely means there are some important things to consider. YMAX is a complex product. It comes with its own set of risks and rewards. It's not a simple investment. But that doesn't make it automatically good or bad. It really comes down to what you're looking for as an investor.
Right, so for everyone listening, if you're trying to figure out if YMAX is right for you and your income goals, here's the main thing. YMAX is built for income, not growth. It's a way to make cash flow that you can then reinvest, not necessarily a source of income to live on.
You got it. If you're hoping for an investment that will grow steadily over time, YMAX is probably not the way to go. But if you're looking for a consistent stream of income that you can reinvest and potentially see grow over time, then YMAX might be worth a closer look.
And even though those high yields might seem really attractive, there are definitely some trade-offs. You're potentially giving up a lot of growth potential because of those covered call strategies.
That's true. And you have to be comfortable with some complexity and risk. YMAX isn't a passive investment. You'll need to keep an eye on your portfolio and be ready to change your strategy if you need to.
So it's probably not the best choice for someone who wants a simple, hands-off approach.
Yeah, probably not. YMAX is likely better for someone who understands how option strategies work, someone who is okay with a higher level of risk, and someone who doesn't need that income right away.
But even then, as you said before, YMAX is a pretty new ETF. There's not a lot of historical data to look at, so it's super important to do your research.
I agree, 100%. Read that prospectus carefully, understand what YMAX actually holds, and think about how it might perform in different market situations. Knowledge is key, especially with complicated investments like YMAX.
Do your own research, maybe even talk to a financial advisor, and figure out if YMAX actually fits into your overall investment plan.